The following recording originates from Radio Eastern 98.1 FM's fortnightly financial and life planning segment. Welcome to FLP's Financial Life Planning Podcast. In this segment, we'll be discussing the 9 most important lessons learnt about investing over the past 35 years.
So clearly a lot has happened over that time. I'll never forget the October 1987 share market crash, sitting up in my office in Shepparton and thinking that the world had come to an end. When the
I think a lot of folk felt the same. But
yeah, and everyone is able to refer to, I lost all my money in 1987. Well, the lesson from that, of course, is if you sell, of course you lose. If you don't sell, you ultimately recover. And the share market that day literally fell by 44% in one day's trade. So quite a significant drop. We've then since seen share markets recover, obviously, and we've seen 8 or 9 different ups and downs, significant drops since then, but nothing quite at that scale. Interest rates peaked at around 17% in Australia in the early 1990s, followed by the recession we apparently had to have. Mr. Keating, thank you. We withstood the Asian currency crisis in 1997, the technology boom and then bust, or tech wreck it was called, in early 2000, followed by the mining boom, and then of course the global financial crisis in 2008, where the Aussie share market fell by about 54%, but over a 15-month time frame. So once again, everybody thought the world was coming to an end and things would never recover, and it was only a couple of years later that things were really back to where they were once again. So the most recent decade, we've now endured the European debt crisis and then the resurgence of the US share market, which all investors benefit from if you have exposure to international shares. So I think another valuable lesson is that we tend to ignore international shares. You see that in self-managed super funds a lot. They're typically just made up of cash and maybe Aussie shares, but international shares have outperformed Australian shares for 6 or 7 years in a row now. So despite all these market events, as someone once observed, the more things change, the more they stay the same. You would have experienced that, Russ, over
exactly.
a couple of extra decades than me being around.
Don't rub it in.
This is particularly true, of course, in relation to investing. So what we have now done is put together our thoughts on the 9 most important things learned over those 34 odd years. So number 1, there's always a cycle. So over 3 decades we've seen and witnessed all asset classes going through various cycles. That includes Australian shares, international shares, commercial and of course domestic property. We've seen a bit of a downturn there just recently as well. Infrastructure assets, alternatives, bonds and even cash. So clearly we're at the bottom, if you like, of the cash cycle right now as well. So one of Australia's leading economists believes that there's always a cycle when it comes to investing, being Shane Oliver. And some of them are short term and some get stuck in the longer term cycles. Obviously cash is near the bottom of that cycle at 1.25%, and in 2008 during the GFC, the cash rate, the RBA cash rate, was as high as 7.25. A lot different today.
It certainly is.
Number 2, the crowd gets it wrong at extremes. So when markets are at its most cyclical, the bottom of these cycles, or the top for that matter, the investor's behaviour magnifies the situation by making typically quite irrational decisions. It's been our biggest challenge over those 3+ decades, Russ, is what we call behavioural finance, and we've done a lot of study and enjoyed working in that area, and we've often mentioned that if we do nothing else but stop our clients making bad decisions when things get tough, well then we'll have added some value. So those irrational decisions typically take people away from the basic fundamentals of investing.
What's along the lines of something that I just thought of: when you go to an annual meeting, sit on your hands.
That's it.
And then you can't get elected.
Fair enough. We often feel the safest when investing in asset class when we get advice from the neighbours, the friends, the workmates, whatever it might be, the golf buddy, and that message is often reinforced as the right thing to do, and it's often what we call, and the media does that of course, Safety in numbers approach is often or usually doomed to fail. So the rise and then fall of Bitcoin, was a classic reminder of the cyclical extremes driven by irrational investment decision making. For example, in December 2017, and the Bitcoin price peaked at $17,900, which is up around 25,000 today. Just when people were getting really interested and exciting, it's again sentiment that drives markets up and ultimately down. But then the Bitcoin price dropped by a third of its actual value at the time, so $6,000 or $7,000 in a 24-hour time frame. So what do people then do? They continue to sell out and got as low as $4,000 US from its high of almost 18,000. Today it's sitting around 8. Number 3 would be yesterday's winners are often tomorrow's losers, so we don't follow or chase the best returns. That's important. So over the journey we've seen a lot of many start performing asset classes that outperform 1 year and almost without fail underperform just a year or two later. This is often the case as the more loved an asset class becomes, the more overvalued it typically becomes because people buy unnecessarily sometimes, which falsely inflates share prices as well. Ultimately, at the end of the day, the less desirable investment is the price point perspective that we should be looking at. So buying the bargain, not the overinflated prices. So in the marketplace, the reality is that many investors find it easier to justify buying investment after it's had a strong run because confidence is high, and they sell when they've had a big fall because confidence is low. The investors that are willing to pay for a less desirable asset but quality asset are the ones who are presented with a higher prospective return, so buying low and selling high, whereas most people do the reverse of that. Number 4, getting investment markets right, it's not as easy as you think. So in hindsight it looks easy, and looking back, have you experienced that, Russ, over the years?
Did you notice my little smile then?
I did, yes. So everything's easy in hindsight, I guess, not just investing. But looking back, it can often look obvious that a particular boom would go bust when it did, but looking forward, no one has a perfect crystal ball to predict those sort of busts. So given the difficulty in getting market and stock movements right in the short term, for most of us it's best to get a long-term plan and suits your level of wealth, age, your tolerance for volatility, and stick to that diversified approach or investment plan. So diversification, as we mentioned before, Russ, is not about putting all your eggs in one basket. So good examples of that would be if people buy an investment property in isolation, it's just one asset. Whereas with an appropriate diversified portfolio, you've got 800 to 1,000 different investments in one portfolio. So if one of those stocks or assets doesn't go so well, it doesn't really matter. It's sort of smoothed out nicely. Whereas you've got 2 or 3 stocks and one doesn't go well, a third of your portfolio can be hit pretty hard. It's also important not to over-diversify either, though, so that will only complicate things for no benefit. Number 5, investment markets don't learn. So a key lesson from the history of investment markets is that they don't seem to learn. The key mistakes are repeated over and over as markets bounce from one extreme to the other through the various highs and lows. It's even though after each bust, many say it will never happen again, and the regulators move in to try to make sure it doesn't. Reality is it usually does. So often just somewhere else, or another country, or another asset class. The whole boom and bust starts all over again. So sure, the details change, but the pattern doesn't. As Mark Twain once said, history doesn't repeat, but it does rhyme. Individually, we learn, and the bigger the blow up, the longer the learning lasts, hopefully. But there's always a fresh stream of newcomers to markets, and in time, collective memory dims and enthusiasm takes over, and not always justified enthusiasm. So number 6, compound interest is like magic. So over the journey, We've always seen our clients increase their wealth by adapting a long-term growth investment strategy. Saving regularly in growth assets can increase your wealth substantially over long periods. So what we learned very early on, Russ, was the good old rule of 72. And it's pretty simple. You just divide whatever your expected return is into 72, and that's how many years it'll take to double. So you probably can't even get it to 2.5% term deposit right now, but let's use 2.5% as an example. Divide that into 72, and it's 29 years to double that asset. So you're not going to double your money in cash unless you were happy to wait around for 3 decades. On the other hand, if your expectation was more like an 8% return, you divide 8% into 72 or 8 into 72, it only takes 9 years for your money to double. And if somebody had an expectation of 10, well, it's then 7.2 years, etc., etc. So just a great example of the power of compounding. If we put $1 in Australian cash in 1900, today that'd be worth $240 by just reinvesting all the interest and allowing it to compound. If we'd been invested in Aussie bonds during the same period, the $240 would jump to $950. But if we allocated it to Australian shares, and that's just the share index of the largest 200 odd companies, that $1, reinvesting dividends, buying more shares, reinvesting, etc., that $1 would now be worth $593,169. So
We can't turn the clock back.
we can't. So is the difference of $240 and $593,000 enough to be noticeable, Russ?
Very much so. Oh, golly. It's scary when you start thinking about that sort of thing.
It's pretty amazing, it really is.
And, sort of also thinking from wherever you are on the age scale, trying to think forward 30 years is a little bit difficult as well.
We tend to live, you're right, we tend to live a little bit too much for today.
Yeah.
But yeah, if it's getting the balance of the long-term strategy and still enjoying today as well.
Well, I guess one of the tips there is to do it early enough so that there's a bit of time for the expectations to be achieved.
Yeah, just digressing for a moment, Russ, my own personal example of this must have been, and I have mentioned this, I reckon 12 months ago, but I walked into an MLC office in Shepparton way back in, when I was 17 in fact, so we're talking a bit over 40 years ago now, and in those days you paid your $20 over the counter into your superannuation fund. It was called collector policies way back then. That $20 linked to CPI over 40 years adds up to a 7-figure sum, so it's crazy.
Yeah. Quite well worth thinking about, but I guess we've set some of our listeners' brains whirling out there.
We have, hopefully. So, although the average return in Australian shares, I say just, but it's 11.8% in that index, counting dividends being reinvested, it's only just double that of Australian bonds at 5.9%, but the compound effect changes that from $950 to $593,000 over almost 119 years. So the magic of compounding, higher returns leads to a substantially higher portfolio balance over longer periods of time. So whether it's 10 years or 100 years, the net results are still there. Obviously, there's lots of rough periods along the way for shares, but the impact of compounding at a higher long-term return is huge over those longer periods of time. Number 7. Pays to be optimistic. So the well-known advocate of value investing, Benjamin Graham, who taught Warren Buffett how to invest, by the way, and he's the most successful investor in history. So Benjamin Graham observed that to be an investor, you must be a believer in tomorrow, in a better tomorrow. So you must be a believer in a better tomorrow to be a successful investor. So what he means by that is if we believe the banks will look after your term deposits within reason, that most borrowers will pay their debts, that most companies will grow their profits, that properties will earn rents, then you should invest. You should be an investor. So since 1900, the Australian share market has had positive returns in roughly 8 out of 10 years. And for the US share market, it's roughly 7 out of 10 years. So what we're really saying is getting too hung up and worrying about the next 2 or 3 year downturn out of the 10 the markets may fall, the risk of missing out on the 7 or 8 years out of 10 when it rises, that's really what it's all about.
Exactly.
There's good examples too. Fidelity just put out a paper recently showing that if you just stayed in the Australian share market for the last 15 years, at the end of March, you would have made 250% compounded. If you jumped out and missed just the best 5 days of returns during that time frame, it dropped to 170%. If you missed the best 30 days out of 15 years, it dropped to basically zero. So it's not just missing out on that one day where it jumps by 4 or 5%, it's the compounding effect you don't get on that 4 or 5%.
That's right.
So you just have to be in there each and every day. Number 8, keep it simple. So investing should be simple, but most investors have a knack of overcomplicating things. It's getting worse today with more options at hand. So we've got more information, more apps, more platforms, more rules, more regulations around investing, and we're continually bombarded. And back in the good old days, you'd have a catastrophic event happen now and you wouldn't find out for a day or two. So share markets were delayed and people would have time to cool off a little bit, whereas now an event happens and we all know instantaneously.
Straight away, that's right.
Right around the world, and that does affect investors more as well. But when we overcomplicate investments, we can't see the wood for the trees, so it's important you keep it simple and stick to your long-term investment plan. Number 9, lucky last. So you need to know yourself to succeed at investing. So if you don't have the time, the expertise, or would rather do other things like playing golf, working at your day job, working at Radio Eastern, Russ, or having fun with the kids, the grandkids, that it may be best to seek some professional advice. The fact is that investing is not easy, and there are a number of investor psychological traps to deal with along the way, which we've discussed today with that what we call behavioural finance. For instance, how would you react if your investment suddenly dropped by 20%?
Panic.
Panic, there you go. Carol in the studio as well. What if it increased by 20%?
Yeah, well, leave it there.
You leave it there. There you go. Well, why wouldn't you leave it there when it drops by 20?
Yeah.
A great example of the typical reaction which we deal with.
Yeah.
It's also a proven fact that we enjoy a rise in the share market or our investments twice as much as we feel the drop, if that makes sense. It's the other way around. We feel the drop twice as much as we enjoy the same rise in the other direction. So, interesting reaction there, Russ.
Yeah.
Seeking professional advice can help us through and guide you through the many different scenarios you're presented with as being investors, and put in place an investment strategy that aims to offer greater stability over time, over the long term. So we often discuss with our clients as well that it's not just about the capital growth, but it's also about capital preservation. There is ways to be careful to minimise the drops as well.
Thank you for listening to this edition of Financial Lifestyle Partners podcast. Please note, the information provided in this podcast is of a general nature and does not factor in your personal circumstances. If you require any assistance with your own financial life planning needs, we would welcome you to contact our office on 03 9873 4000.